what the Federal Reserve is doing is banks have to keep a certain amount of capital on hand to meet minimum deposit requirements. And if they run short of that, they go to the Federal Reserve to borrow money to make sure they have enough money on hand. So if they have to pay more to borrow from the Federal Reserve, that means that the bank is going to charge you more money to borrow from them.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This is episode 89. And this week we're going to be talking about how an interest rate increase can impact your retirement. And you may have read or heard that the Federal Reserve will be increasing interest rates. And I'm actually recording this episode on March 16th, the day that the Federal Reserve did increase interest rates. So I want to talk about what that means and some of the ways it can impact you. So first, talking about the Federal Reserve and central banks and how they work. So central banks around the world, one of the ways that they control economic activity is by raising interest rates. And when an economy is heating up or going too well to curb inflation, they can raise interest rates. And when things are not doing as well, when the economy is sluggish, then they can lower interest rates. And in the U.S., that is controlled by what's known as the Federal Reserve Board. And for the purpose of this podcast, we'll just refer to them as the Fed. So that is one of the tools that the Federal Reserve, or the Fed, has to combat inflation. Now, our Fed has a dual mandate, and that's to promote maximum employment and to promote price stability. Now, as we know, recently, and I've talked about this in past episodes, we probably don't have a lot of price stability right now. We have a very high rate of inflation. Consumer price index increased 7% over last year. So the Fed is in a difficult position where they need to increase interest rates, but they're also trying to balance that against what's going on as far as, possible geopolitical events with the war between Russia and Ukraine. So they're in a difficult balancing act. And earlier today, they raised the Federal Reserve rate by 0.25%. So that's a pretty minimal increase. People were expecting between 0.25% and 0.50%, but nevertheless, it's still an increase, and there's the expectation that there'll be further increases this year. So I want to get into some of the ways that can impact your retirement. So let's just start by the first way. This could impact your spending. With every loan that you take, unless it's from a family member who's very generous, you're paying someone back interest. And this interest is compensating them for them lending you the money. And depending upon your credit and the amount of money you're borrowing and the time frame you're borrowing the money will dictate the interest that you're being charged for that loan. And most people are familiar with this if you have a home mortgage loan, or you take out a home equity line of credit, or when buying an automobile, if you use a loan for that. We've had a really low period of interest rates. Maybe you've even been able to refinance your mortgage because interest rates have been extremely low. So this increase in interest rates is signaling future increases. So we've already started to see that even before the Fed raised interest rates, the borrowing rates have gone up. And banks and lenders dictate their lending rates based on what the Federal Reserve interest rate is. Because what the Federal Reserve is doing is banks have to keep a certain amount of capital on hand to meet minimum deposit requirements. And if they run short of that, they go to the Federal Reserve to borrow money to make sure they have enough money on hand. So if they have to pay more to borrow from the Federal Reserve, that means that the bank is going to charge you more money to borrow from them. It's become a lot more difficult to find a mortgage rate of sub 3%. Many people are able to lock in and refinance with interest rates of 3%. So this is definitely going to cut back on the ability that you can spend, because if you're looking to buy a new house, or you're looking to buy a new car, or some other purchase that you're making where you're going to be financing it by taking out a loan, it's going to cost you more interest, which means you have less money to pay towards the purchase, right? If you have a finite amount of $500 a month that you can afford for your car payment, if you're now paying more interest, that means that you're buying less car. This might also cool off the real estate market a little bit because just like going to buy a car, if you have a fixed amount of money that you can afford for your mortgage payment and now you're paying a higher interest payment, there's less of your money that's going towards principal. So that means you can afford a smaller loan than you could even a couple months ago. It might pull back some of the really strong bidding wars that are going on in the housing market, making it difficult for a lot of people to find a house. Way number 2 is that it can have an impact on inflation and hopefully a positive impact. As I mentioned before, we've seen prices rising on many things, many goods, and that's not a good thing. You always want to have some inflation in the economy because you want things to be going up in the future. If you have deflation where the cost of things is going down in the future, that's going to cause people to not spend money. Because if you knew you could wait 6 months and you could buy a car for $2,000 less than you could buy it today, why would you buy the car today? You would wait. And if we have enough of things like that going on that are going down in price, people stop spending, and also manufacturers sometimes don't produce as much of a product, which kind of can slow everything down. So the Fed keeps a close eye on the consumer price index, and that is one of the indicators that they're looking at. And because the consumer price index has been rising at such a high rate, they are in a position where they need to raise interest rates. To look back over some of the Fed's previous actions, if we look at, for example, leading up to the financial crisis in 2007 and 2008, the Fed drastically lowered rates back then to help jumpstart the economy. And so rates were cut almost to zero. And 8 years later, rates were still close to zero. And then it wasn't really until 2015 to 2018, as the economy strengthened, that the Fed raised interest rates 9 times during that period. And then fast forward to 2019, right? We're struggling from COVID. Things were being shut down, a lot of slowdown. The Fed cut interest rates 3 times in 2019 and twice in 2020. And here we were again at rates almost near zero. And that's why, you were able to refinance mortgages and get loans at a very low rate because the rates were cut to zero. And going back even further, a really extreme period of time occurred from 1980 and 1981 where inflation was at 14%. And that was a period of time where you could go into a local bank and you could get a CD rate maybe paying you 10%. But we had really high inflation, which wasn't good. So the Fed was forced to raise interest rates to 19%. And maybe some of you listening even had a mortgage that you took out that had a double-digit interest rate of 10% or higher. Could you imagine taking that out today? But there was so much inflation that was relative to the times. But this caused a severe recession that lasted a while, but it did help put an end to the really high inflation that was going on there. So I think the Fed is trying to avoid anything like that, where inflation is at a runaway pace, and it's definitely mistakes that people would point to that were made by the Fed during that time frame, and that they're trying to avoid that, and hopefully they do. So that brings us to way number 3, they can impact you, and that is it can have a negative impact on your bonds, on the bond portion of your portfolio. To understand that, interest rates in bonds have an inverse relationship, meaning that if interest rates go up, that will push the price of your bonds or bond funds down. So just to explain it this way, let's say that you have a bond in your portfolio that's paying you 2% interest. And that same bond now, 6 months later, because of interest rate increases, is the new bond would pay you 3%. That would mean that your bond at 2% isn't as desirable because a new investor could go out and buy a new one at 3%. So that would cause the price of your bond to fall. It would have to adjust to the price of the new bond. So this is where the negative impact that can happen with rising interest rates. It can cause the price of your bonds and bond funds to go down. And the opposite would happen if interest rates were falling. It would cause the price of your bonds to go up. So that's what happened for the last 3 years, where interest rates were being lowered and you saw pretty good returns in the bond side of your investment portfolio because interest rates were going down. Now we're about to go through the opposite. So how do you combat that? Well, you definitely want to stay in the shorter to intermediate term bonds. You want to stay away from long-term bonds because the longer the term of the bond, 20, 30 years plus bond, whether it be government or corporate, the more sensitivity it has to interest rate increases. And this is the big unknown. No one knows what the Federal Reserve is going to do. Are they going to raise interest rates by 1% this year? Is this the start of something big, or is it going to be a more gradual increase? So as an investor, you certainly want to get the most income you can from your bonds, and that generally is by buying longer-term bonds. But the risk you run by doing that is that you could see a decline in the price of your bonds. Now, if you own individual bonds, that's okay as long as you don't sell them and you hold them until they mature. You'll get back your original principal, but in the meantime, you'll be losing out on collecting some additional interest you could have had by staying rather short-term. So that's definitely one thing to look at. Look at the bond, the bond side of your investment portfolio, how that's positioned, and maybe shorten some of that duration. Ideally, you would have done that a little while ago, because even before the Fed was raising interest rates, we were seeing in the bond market, most notably as measured by the 10-year U.S. Treasury index, and you could look this up on Google, or even on the stocks app. If you have an iPhone, it's TNX is what you'd look up. But if we look at this over the last 12 days, the 10-year U.S. Treasury yield on March 4th, and I'm recording this on March 16th, was 1.7%, and today it's 2.188. So that's a 0.5% increase, which is a really big move in 12 days, and that equates to a 28% change. If we look back 3 months ago, on December 16th, it was 1.422. So measuring that from then to today of March 16th, that's a 0.766 increase, which is 0.75% roughly, and that's a 53% change. So those are really big moves. So that's why, as I mentioned before, the interest rates have gone up a lot on the borrowing costs in the real estate market if you're looking to take a home loan or if you're looking to take a car loan. So definitely keeping an eye on what you have in your portfolio, sticking to shorter term bonds can be a good idea. Or if you did buy long-term bonds, maybe holding them until they mature. But also, if you have money in short-term savings or money market or short-term CDs that are maturing soon, the benefit that you're going to receive is that because these interest rates are going up, you're going to earn more on a money market account or a short-term savings account or a 6-month or a 1-year CD. So that will also benefit investors as well. So way number 4 that this could impact you is on the stock portion, the U.S. stock portion of your portfolio. So this is where it becomes a little trickier because there isn't a direct correlation as there is with bonds with rising interest rates and prices. Stocks can rise or fall depending upon how interest rates increase. A majority of the time, generally a year later after there is an increase in interest rates, the stock market has a positive return. There's a few reasons for that. One being when the Federal Reserve is raising interest rates, that means that things are good and they believe they're going to continue being strong economically. And economically doesn't always translate to the stock market, but generally when things are good in the economy, it means people are spending more money, which translates into companies making more profits, which is usually good for the stock market. It can be negative in the sense that if we do have a lot of inflation, which we've had recently, there's the possibility that might not actually be good for stocks because it could cause people to spend less money or be able to spend less. So that is the challenge. Maybe not all sectors of the stock market will do well. And there's generally about a 12-month lagging effect anytime there's an increase in interest rates to actually see that flow through to the stock market. But one of the other tools that the Fed has to control the economy is by buying bonds, both treasury bonds and mortgage bonds. So if they're buying bonds, they're putting more money into the economy, and they've been doing that for a long time to help stimulate things. Well, the Fed has signaled they're going to stop the buying that they're doing, and they're also going to start selling some of their bonds. So that could also be a concern that if they do this rather quickly, while they're raising interest rates, they could be taking a lot of liquidity out of the market, which usually isn't good for the stock market. But today they've signaled that there is no schedule for that. It's something that they're talking about. And this combined with this low increase in interest rates is a positive sign for the stock market. So I think the bottom line is that this interest rate increase is generally seen as positive for the market. Hopefully it will have some impact on inflation. Shouldn't have a major impact on your investment portfolio as far as being negative, and maybe even can turn out to be positive. So I hope you found this episode helpful. And as a reminder, if you have any questions that you would like to have considered for a future podcast, please go to retirewithryan.com, then click out on the contact button and fill out the contact form, and we'll consider that question for a future episode. Have a great week, and I look forward to talking to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.